Movie banking is shouting wire transfer. Real life, checking versus savings. In minutes, what each account actually does, why HYSA beats 0.01%, and a simple spend versus save setup you can copy today. Before we start, hit like and subscribe. If your only knowledge of bank accounts comes from movies, where someone yells, wire transfer, you're in the right place. Banking is not glamorous, but understanding the difference between your checking account and your savings account is non-negotiable for financial survival, and they are absolutely not the same thing. So what's the difference? Factually, a checking account is designed for high liquidity and daily use. It's for depositing your paycheck, paying bills, and using your debit card. It offers virtually no interest because the money is constantly moving in and out. Think of it as your financial fast food lane. Quick, easy, and not designed for long-term health. A savings account, conversely, is designed to hold money for a longer period. It is factually where your money should earn interest, though traditional accounts often pay pathetically low rates. It restricts the number of withdrawals you can make per month because it is not for daily transactions. How does it work? Let's talk about the key factual difference: liquidity and purpose. The checking account's purpose is to facilitate transactions. It needs high liquidity, meaning the cash must be available immediately. The savings account's purpose is to preserve and grow your money slightly. A critical piece of factual information here is the high-yield savings account, or HYSA. This is factually a type of savings account, usually offered online, that pays a significantly higher interest rate than a traditional bank. This is where your emergency fund and short-term savings goals should live, allowing your money to factually fight back against inflation. If you're saving money in a traditional bank savings account that pays 0.01% interest, you're essentially losing money every day. It's like leaving your cash under a mattress, only worse, because the mattress sends you a useless monthly statement. Let's look at a factual example of how this should work. Imagine you get a $500 paycheck. You immediately transfer $100 into your HYSA for your emergency fund and $50 into a checking account buffer. The remaining $350 sits in your checking account for the month's bills and spending. If you need to pay rent, you use your checking account. If your car breaks down, you pull the cash from the HYSA. Crucially, you should rarely, if ever, transfer money from your HYSA to buy daily groceries or clothes. The system keeps your spending money separate from your wealth-building money. The danger of ignoring this distinction is factual and twofold. 1. You confuse your savings with your spending money, leading to accidental spending and a depleted fund. 2. You are missing out on factually proven returns by keeping large sums of money in a zero-interest checking account. The benefit is clear organization. Having separate accounts creates factual financial boundaries and puts your money in the right place to perform its specific job. The single most actionable takeaway for you today is this: open a high-yield savings account. It takes 10 minutes, and transfer your emergency savings into it. Separate your spending money from your savings money immediately. Finally, remember, this is not financial advice, only education. The principles discussed here are factual and based on standard banking concepts. You must check that your bank is factually insured by an organization like the FDIC or equivalent state agency before depositing money. Now go find an account that pays you more than 1 penny a year. Your money deserves better.